The world of business is like a banana. There is a plethora of information available. However, this information is veiled behind a clutter, which makes it difficult to comprehend the core of the issue at hand. It often happens that decisions are left to ambiguity because their interpretations are not clear or visible to the naked eyes. While the accounting system helps accumulate data and present it in a structure that allows getting significant information, decision making in business involves delving further into this layer of assemblage. This process is an art which helps one make informed decisions in business, and learning this shall help each one of you grow. Welcome to Managerial Accounting and Decision Making. The subject helps you gain an understanding of the financial accounting system to allow peeling of this banana and derive the essence out of financial information. Understanding the fundamentals of topics like budgeting, variance analysis, and profitability analysis goes a long way in making sure that no conclusion is derived by gut feels or rudimentary analysis of data anymore. We have the honor of having esteemed faculty in the form of Professor Swaminathan Sridharan from the Kellogg School of Management, who, having taught at the best B schools globally, uses a pedagogy that goes beyond pages of the textbook, uses real-life examples you can connect with, to gradually make you understand the concepts in a relatable fashion. So, what do we wait for? Let's get on started with the subject and what it offers to you. Now have a look at these companies here, all stellar in their respective fields. Pick any reputed company you know in any domain of any size, irrespective of all other differences. One vertical shall always exist in all such companies, and that is accounting. Whether it is a technology company, a design firm, or a consulting services organization, it goes without saying that they shall have a strong accounting team. However, it does not really imply that the utility of accounting knowledge is limited only to accountants. For instance, marketing teams, sales teams, strategy team, etc. all need to have a basic understanding of the way accounting presents data and their interpretations to be able to take the knowledgeable decisions. You might ask why. So let us understand why is it important for a person working in an organization to study the subject at all. Firstly, it allows you to take decisions in complex situations. The complexity of information grows manifold as a company grows. It then becomes important to understand profitability for each vertical or region for the organization. FADM can help understand how costs should be assigned to each division to depict their performance in an apt manner. Secondly, the subject helps an individual understand business phenomenon better, how its cost functions are performing, or how its revenue stream is generating profits for the company. The information may not be readily available for use when making crucial choices currently. Thirdly, the subject helps you plan and utilize resources optimally. Often it is seen that people base their decisions on future predictions. It is then important to know how the entire company's outcome would look given the conditions that can possibly prevail, to plan contingencies and budget for resources accordingly. Let's discuss some of these in detail. Have you heard of Apple? Who hasn't? But what has kept Apple in the news these days is its tussle with EU over $14.5 billion in taxes. And these taxes find their source in transfer pricing. Transfer pricing essentially determines which vertical of an organization gets how much revenues or costs get allocated to it. In other words, it is the split of profits by verticals, say divisions, geographies, etc. Now, why is it that even important? With the advent of technology, the world has become a small place, and companies have managed to grow beyond their traditional domains and regardless of their physical locations. It's important then that financials at these multinational companies and business conglomerates be split in an apt manner to show clearly what the level of performance at each of these divisions is. Hence, transfer pricing comes to the rescue, both to understand the process for your own business or for an organization where you are a stakeholder. Are you aware that Bharti Airtel has outsourced most of its verticals except primarily sales, marketing, and finance? It speaks of two things. One, how important finance is at the core of the company, and two, how far has the outsourcing industry grown? Outsourcing is used as a mean to achieve transactions without having to invest a lot. Whether it is the domain of manufacturing, logistics, or services, we can find outsourcing as an opportunity everywhere these days. However, choosing to outsource is a task not easy at all in terms of business model changes and in terms of finances. A business needs to understand the financial implications of outsourcing before it chooses that course. It is not necessary that outsourcing can remove all costs for a company. It may so happen that some costs are fixed in nature and may continue even after outsourcing. Thus, a correct decision would entail an understanding of such concepts, which are explained with practical, easy to understand cases during the course. Another concept that gets covered in the course is activity-based costing. Say you are a food company. What is then your cost to serve each customer? When you look at in totality, it's difficult to understand which costs are affected by a particular activity. For example, how can the company split costs of a salesperson to each customer? The effort can probably be split according to the value of the sales that the salesman does. Cost of logistics would probably be a factor of the volume of material transferred. It is then important to know which factors affect which costs and charge a product, a customer, or a business division in accordance with the usage of these factors. ABC costing introduces you to the subject in a manner in which you can understand and apply the concepts to real-world problems.
Let's look at a few more important business aspects where managerial accounting comes into the picture. One such scenario is identifying your most profitable customers. Now, one could say that it is the customer that provides the highest revenue. But consider this. Let's say the products or services we are offering differ from customer to customer. In this case, we should also consider how much resources are consumed in providing the product or service to each customer. The customer providing the highest revenue could also be consuming a disproportionately high amount of resources, hence bringing down the customer's profitability for the firm. Now, continuing with the idea of optimal use of limited resources, let's look at profitability of products. If we are offering multiple products, one way to identify the most profitable product would be based on margins. But once again, we may be limited by the resources, for instance, the number of machines to make these products. And a product with slightly lower margin could be taking up just a fraction of our machine time, effectively making it a more profitable product to the firm. Therefore, what we should really be looking at is the profit contributed by a product for each machine hour that it consumes. So we see how managerial accounting enables us to define what profitability really means in different business scenarios. Moving on to another very important aspect, budgeting. Getting the budgeting right is crucial as it acts as an input to various other decisions. It helps determine the funds that we would need. It also determines the orders we would place with our suppliers. And this has the potential to impact not only us, but also the supply chain. Managerial accounting helps understand the flow of the budgeting process and identify critical elements that need to be considered while budgeting, for instance, exchange rates in case the firm has international operations. But budgeting is a forecast, and actual numbers for profit, cost, etc. may look different. And there could be various factors for that: sales volumes, raw material costs, labor costs, rent, insurance, and various others. This is where variance analysis comes into the picture. It enables us to identify how much of the differences between the budgeted and the actual numbers can be attributed to each of these factors. While some effects, such as drop in profit due to decreased sales volumes or increased raw material costs, may be easy to identify, certain others, such as improved profits due to operational efficiencies, could be hidden in the numbers. And this is what variance analysis helps us figure out. Finally, after covering various scenarios in which managerial accounting aids decision making, I would just like to point out the differences between managerial accounting and financial accounting. As we've seen, managerial accounting is primarily inward looking and enables effective planning and decision making, whereas Financial accounting has a significant focus towards external stakeholders such as investors and shareholders, and in this context is used primarily for reporting. Another key difference is that while financial accounting has rules for a majority of the scenarios, managerial accounting brings in the challenge of looking at each situation differently and defining key factors such as the drivers for cost and key metrics such as profitability. And with that, I would like to end the presentation. Thank you for listening.